Well, who's winning the performance race? Is it actively managed funds or is it their index peers? Morningstar's latest active passive barometer is a detailed report on over 4,000 funds with almost $16 trillion under management, and it's just been released. And on today's show, Ben Johnson, author of that report and Morningstar's director of global ETF research, joins us right after this. I'm Ron DeLegge with ETF Guide. Happy to have you with us. Now, if you're new to the channel, be sure to check out our one-of-the-kind programs like ETF Battles, as well as the Portfolio Report Card. And don't forget to hit the like button if you've been enjoying our content, and also be sure to subscribe. So Morningstar's Active Passive Barometer is one of the ETF and fund industry's most comprehensive reports. It looks at historical performance and survivorship across various mutual fund categories. And here to explain to us some of the important details of the latest report is Ben Johnson. He's author of that report. He's also a CFA and Morningstar's director of global ETF research. Ben, welcome. It's great to have you with us.
Thanks so much for having me, Ron.
So let's start with the popularity of indexing, especially with ETFs. We know that it's been rising dramatically over the past 2 decades. Yet there's still a lot of money still invested in actively managed funds. So can you give us some context, some perspective? Who has more money under management? Is it active funds or is it index funds?
Well, it's a great question, Ron, and it really all depends on how you manage it. So if you're to look at just funds, so open-ended mutual funds and ETFs, what you see is that within stock funds, index mutual funds and index ETFs now hold the majority of investors' assets. They still own a minority of assets when you switch over and look at fixed income funds, bond funds. And if you zoom out more broadly, what you see is that despite the tremendous amount of growth that we've seen in indexing, both within regulated funds, outside regulated funds, all index portfolios everywhere around the globe of all shapes and sizes still own, let's call it roughly a quarter of global stock markets and a much smaller portion of global bond markets. So while indexing has grown tremendously over the course of the past few decades, it's still got a long ways to go before indexed portfolios were to own a majority of all of the stocks and bonds in the world. It's very likely that we may never reach that point.
Well, thank you for that perspective. Now, let's talk about the success ratio of active stock and bond funds in outperforming their passive or index yardsticks. And according to the report, at least the numbers that I saw, it was not good in most categories. I guess the one that surprised me was the low rate of success among U.S. large cap growth funds, because growth stocks have actually been great performers over the past, let's say, decade. And I'm confounded by why the vast majority of large cap growth funds have actually underperformed despite having a pretty favorable backdrop behind them. Am I misinterpreting the data? What do you see here?
Not at all. You're interpreting the data correctly, Ron. And what you're seeing there is really something that some might know is what's called Dunn's Law in action. So what Dunn's Law states is that when any given particular segment or style within the market does very well, it outperforms other styles, other segments of the market, it becomes difficult for active managers to keep up because the indexes that they benchmark themselves to are the purest form of that particular style, large cap growth in this case. So large cap growth stocks have done incredibly well in recent years. And because indexes focus exclusively on large growthy names, whereas the active managers in that category might start to color outside the lines. They might own some smaller names. They might own some blend or value names in their portfolio. They might even have a residual of cash. They're going to have a harder time keeping up. It is almost counterintuitive when you see such tremendous performance within large cap growth is a category to see active stock pickers have a hard time keeping up during such an environment. And what you see actually on the flip side of the coin is that in 2020, value managers as a group had a tremendous year as measured by their success rates. Their success rates went up dramatically versus 2019, but that's not to say that they performed well. They just performed better than their very style pure benchmark indexed peers, which have the purest expression of a value strategy, and value suffered in a big way in 2020.
Let's talk about actively managed bond funds. In the Morningstar report, I noticed that the success ratio of outperformance by active bond funds over their index or passive yardstick really drops off over the long-term time horizons. So what jumps out at you in the bond category?
Well, generally speaking, what we've seen in bond portfolios and in the bond categories that we include in our study, of which there are three. So we look at intermediate core bond funds, we look at corporate bond funds and high yield bond funds, is that relative to their peers that are picking stocks, bond portfolio managers have had generally better odds of beating their benchmarks. And a lot of that really speaks to the style purity, again, in the constraints on some of those benchmarks. So if you take the intermediate core bond category as an example, most of the index funds in that category are underpinned by the Bloomberg Barclays Aggregate Bond Index. And that index has very explicit rules. It sweeps in investment grade bonds across government and corporate space. And as a result, what it leaves out of its portfolio are some more credit risky bonds, for example, that might be just on the other side of investment grade and high yield that are fair play for active managers in that space who might invest a portion of their portfolio in those riskier names. So when those risks are rewarded, those managers actually have a fairly easy time beating that benchmark, where those particular bonds that they're bringing into their portfolios are off limits for an indexed fund. Now, that will reverse, and often reverse sharply, when you see unfavorable conditions arise in credit markets, as we saw early last year, and relatively safer portfolios like an ag tracking index fund are going to do better during times of stress, times where we see a flight to quality in bond markets. So, generally speaking, success rates among active bond funds higher than what we've seen in US stock pickers portfolios, though over a long period of time is still relatively low, and partially that's explained by the fact that the importance of fees is really amplified in a segment of the market where expected returns are lower, as they are in bonds relative to stocks.
Yeah, and that is one of the things that really jumped out to me about this report. If you want to invest in active funds, then you should probably stick with the less expensive funds, because those are the ones that tended to outperform compared to their higher cost active fund counterparts. Tell us more about that.
It's really just the height of the hurdle at the end of the day, Ron. So when you think about it, if I'm an active manager and my success or failure is in large part just a factor of how high is that hurdle that I have to jump over? Do I want to set the bar up here, or do I want to keep it lower? And the fee is the hurdle in this case. So any amount of fee that I'm going to charge as a discretionary portfolio manager is an amount that I'm going to, at a minimum, have to earn back to produce index-like performance. If I want to outperform the index, I'm going to have to earn that fee back and then some. So the higher the fee, the higher the hurdle, the more difficult it is for me to succeed over the long term. And each penny that an investor is paying in fees is a penny that they're not keeping for themselves. It's a penny that's not being invested and not compounding between here today and wherever their long-term goals are further down the road. So the tyranny of compounding costs, as the late Jack Bogle would refer to it, is real, and it's important that investors keep a tight rein on fees, because we've seen, and it should be no surprise, that success rates among the cheapest funds in a given category tend to be higher, and in some cases much higher, than success rates among the most expensive funds in that same category.
One final thing, Ben, before you take off, a high proportion of actively managed funds are failing to survive. It's alarming. It's especially disruptive to a person's long-term investment plan. So what do investors need to know about this?
I think investors need to know that not all funds are going to be around 2 and 3 and 4 and 5 and 10 years down the road. And one of the biggest factors explaining many active funds' failure to succeed is really just a failure to survive over the long term. And if you poke around a little bit in the fund's graveyard, what you see is that most funds that fail to survive because they failed to deliver the goods. Most funds, by the time that their doors are shuttered, that the lights are turned out, have failed to outperform their indexes or their passive peers for that period of time from their birth till their death. So investors need to be very careful. I think they need to, first and foremost, again, keep a tight rein on costs, because what we see is that survivorship tends to be higher among less expensive funds, while the most expensive funds tend to die at a higher rate. They're either merged or closed entirely. And investors need to pick their spots. There are just certain corners of the market. Certainly, if you look outside of US stocks and into international stocks or in the fixed income markets, where investors' odds of picking a winning manager are higher, the payouts produced by those managers, the returns that they generate in excess of an indexed alternative tend to be greater. And those are the areas where investors should really focus. And their odds get better still, again, not to sound like a broken record here, but if they focus on the least costly options within those categories. And that really, I think, resonates. It comes through clearest in the figures that we include in the report that show comparisons side by side between the equal weighted returns produced by funds in each category, active and passive, and the asset weighted returns. So the latter actually shows where investors have been putting their money. And the good news is that investors have generally picked above average managers. Those asset weighted returns tend to be higher than the equal weighted returns. That said, the asset weighted returns in many categories tend to be lower for active funds still than passive funds. But there are a lot of categories, especially categories in international stock markets. So the foreign large blend category, diversified emerging markets, where the average dollar invested in active funds has actually done better than the average dollar invested in passive funds. So if investors can do a little bit of homework, focus on fees, and pick their spots, they can succeed over the long term with active managers. So as much as the headline figures are grim, really the objective of this report is to help investors to do exactly that, to improve their odds of finding good managers, or alternatively to locate those areas of the market where they might be best served by saying, I don't know, I'm happy to index at a very low cost, or in some cases, for some index funds, no cost at all.
Well, thank you, Ben, for dropping by and sharing your insights. Great job on the report, and keep up the good work.
Thanks so much for having me, Ron.
Again, that was Ben Johnson, Director of Global ETF Research at Morningstar. Don't forget to subscribe to ETF Guide TV. Hit the like button if you've been enjoying our content. And I invite you to post your thoughts in the comment section below. I love to hear from you. I'm Ron DeLegge with ETF Guide TV. Thanks for watching. We'll catch you next time.